I'm Kevin DePew, Editor-in-Chief of MinionVille.com. Joining me today is Bob Prechter, President of Elliott Wave International and the author of 14 books, including Conquer the Crash, which has just been updated and re-released. Bob, welcome.
Thanks.
Before we get into the book, which we obviously want to talk about, I was wondering if you could tell me a little bit about how you came to discover Elliott. You went to Yale, and you have a degree in psychology from Yale, and from there you found your way into Merrill Lynch.
Right.
And then at some point there you discovered Elliott.
Actually, it was before then. And by the way, if you want that kind of story that's a little bit more accurate, there's a website called robertprechter.com.
Great.
With a lot of links on it, and it's not overly long, but it does give you the straight story. I actually became interested shortly after graduating college because my father was a subscriber to Richard Russell's Dow Theory of Letters. Mm-hmm. And back in the early 70s, Russell was writing, of course, all about technical analysis. He was teaching me a lot right there about advanced decline lines and things like that, which were very mysterious when I first read about them. Right. And he started running some Elliott Wave analyses on the Dow Jones Industrial Average and some individual stocks. And he was corresponding with a man named A.J. Frost at the time. And I became curious. Of course, they were only touching the surface about what was there. And then when I joined Merrill Lynch, one of my colleagues had a copy of Hamilton Bolton's first book on the Wave Principle, published in 1960. That was a real eye-opener. And then I decided on my own I needed to find Elliott's original works. And I checked with the Library of Congress. They didn't have them. I found out that the New York Public Library had copies on microfilm. And that was terrific. So I went down there, paid for them to copy every page of both of his books. Later I got Hamilton Bolton's personal copy of Elliott's books. It was very exciting and a great collector's item. But I found there had been so much lost to the practitioners, the few that were there, that I republished all of Elliott's works in a book called R. & Elliott's Masterworks, and now they're on the record.
As someone approaching markets from a psychological angle, was there something specific to Elliott Wave analysis that you gravitated toward versus, say, candlestick charting or point and figure or something?
Not really, because all technical analysis is based on the idea that auction markets have a way of behaving. Now, if they were strictly efficient and reacting to news, they wouldn't have any behavioral characteristics whatsoever. They'd simply readjust to new price demands or requirements based on whatever the news was and whatever the valuations were. But when you start looking at valuation indicators, and you can see that the yield on the Dow, for example, can range between 17% per year and down to 1.3, and where the PE ratio can range between 6 and 120, right. You know that there's no such thing as valuation, some sort of standard or mean that prices are going toward. They fluctuate constantly. Well, what's making this happen? What would possibly create patterns? And I said the only way, it can't be rational thinking. It has to be impulsive thinking. And I finally came to the decision that it was based on a herding impulse. And so a colleague of mine and I wrote a paper that was published in 2007 in the Journal of Behavioral Finance, essentially putting forth the idea that there is a socionomic, and that's a word we can talk about later, basis of finance, which separates finance entirely from the study of economics. Economics is thoughtful, rational valuation when you go to the grocery store, the shoe store, or Walmart. And financial valuation is completely different. There are no benchmarks, and you have to guess what the other guy's going to value it. You are completely uncertain all the time, and when people are in that frame of mind, they herd, and that creates patterns, and that's where the Wave Principle model comes from.
Okay. Speaking of patterns, let's talk about the book, Conquer the Crash. It's been called the Deflationary Bible, or the Bible of Deflation, a compass or a survival book for the coming deflationary depression. Why are you re-releasing it and updating it now? What's behind that? What needs to be updated?
Okay, the second half of the book is a manual on how to get your money in the safest possible places in a deflationary environment. So I spoke to the publisher a few months ago and I said, look, we called this rally. We've got a target of S&P 1,000, 1,100. When we get in that range, I want to do the second edition. We both agreed it wasn't going to sell as many because people now think, of course, the worst is over and we're in the recovery. I said, but look, the few people who do read it on the re-release are going to be able to sell their stocks at a great price. Dow 10,000, S&P 1,100 is a great area. We've already seen complete change in psychology from abject fear when we had only 2% bulls on the 9th of March among traders, and now it's gone up to the 90s. And of course, fear about the economy, and now recovery is there. Fear that the Fed didn't know what it was doing, and now, of course, the Fed's a genius that saved us all. And that's exactly the kind of thing that optimism, after a 7-month period, will make people think. So they're using this part of their brain, but they're not using it so much to reason as to rationalize why they now feel bullish.
Right.
They didn't want stocks at 667 S&P, but they kind of like them quite a bit here at 1080.
After 60% rally.
It'll never stop.
That's right.
Yeah, and the only way to get a 60% rally and profit from it is to jump in front of that bus and say that bus is going to stop because we have 5 waves down under Elliott and the Elliott model, and we have too many bears. It's way too crowded. It's the perfect time for a bottom. Well, retracements can be of all different sizes. I think we're in the right area right now for a reversal. It could go higher if it wants. I kind of doubt it. I think I'm sensing already an increase in volatility in the market. Banks are starting to lead the way down again. So I think we're in the turning area.
A couple of hot button subjects right now, gold, the US dollar. I can't seem to find anybody except maybe the two of us and Elliott Wave International, some of the things that Todd Harris and I write about that are bullish on the dollar and bearish on gold. Or if not bearish, then people who believe that maybe gold is peaked and it's not going to be $5,000 an ounce, $10,000 an ounce.
Yeah.
What's your take on that?
Well, I have a complex opinion on gold, which I get to second. Let's do the dollar first.
Sure.
People detest the dollar right now. We have extreme negativity among traders, but most of all, we have very widespread belief that we're heading into hyperinflation and runaway inflation. And of course, the theme of my book is the opposite.
Right.
We're in a deflationary environment. So remember, in 2008, when all the markets were falling, what was the dollar doing? It was going up.
Right.
That's the counter move. When credit contracts, some dollars disappear. Back then, they were called subprime mortgages. That was the IOUs that were disappearing, along with some others as well. And people had, in order to pay these debts that they had to repay, they had to sell things to get dollars. And that made markets go down. Now we've had this reflationary period, which we expected. Prices of stocks have gone up. Oil's gone up from $35 to $80. Gold and silver have rebounded. Most of the other commodities have as well. Even real estate actually had a blip on the upside, which I thought was pretty funny. But so what happened during that period? Naturally, the dollar went down because this is a reliquefaction due to the fact that people are more optimistic. So the lenders are willing to lend and the borrowers are willing to take some more risk. But if 2010 is going to be the kind of year I think it is, which is a big down year for the stock market, that means the dollar is going to have a replay of what happened in 2008. But since it's a third wave under the wave principle, which means it should be even stronger than the drop in 2008, I think the dollar is probably going to have its best year and a half in a long, long time.
What comes after that, though? I get that question a lot when I talk about the dollar having a move up because of debt destruction, because people need dollars to pay down debts and recapitalize, repair their balance sheets. What happens to the dollar after that?
Good question, because, I think the dollar will basically be strong and buy more stuff during the deflationary period. That should last at least 5 more years. So that's a long period of time.
Right.
You can already buy a lot more property with your dollar than you could in 2005. You can buy a lot more stock shares. You can buy more commodities, and generally speaking. We finally had a negative rate of change in the CPI, and that's a lagging indicator. So I think deflation is going to rule during that time. Now, once we reach stabilization in the credit markets, and either enough people have either paid off their debts or defaulted on them, which is what happened in the early 30s, that's when you can start over, and anything can happen. Sometimes you get a sort of a revolution in the monetary system. We had that in 1932-3 when they said we're going to throw gold out of the picture and just go to pure fake money. We may go the other way this time. Maybe they'll say, well, look, you know what? Gold worked great. We're going back to a gold standard. We're getting rid of our central banking system. That would be terrific. Right. But another possibility, which would be a sad outcome, would be, so many banks have gone under. We're in such trouble. We're going to go to the printing press. We're going to replace all the debt with greenbacks and just print notes, as they did in Germany in 1922 and 23, or South American countries or Zimbabwe. Those things are possible, but while the debt market is many, many times bigger than the money supply, it's not possible. Right. Deflation is the only possibility, in my view.
Well, talk a little bit about when someone talks about a deflationary debt depression or a deflationary depression. What does that look like? What does that feel like to the person on Main Street? Someone who may be watching this that they're an engineer and they go home and they have a 401k, what have you. What is that going to feel like to them?
Yeah, well, that's the tough part, because I can help people, and this book is designed to help people not get hurt financially. But these deflationary periods always impact the economy.